Why could a recession mean the end of the Eurozone?
I think a recession, well, the third recession would have had in a decade, could put at risk the financial and economic future of the Eurozone through a couple of factors. I think, first of all, a renewed increase in unemployment would further fuel the support that we've seen, particularly in southern Europe, for much more radical, populist, anti-austerity parties. And I think after, as I say, if we were to have three recessions on the trot, effectively pushing the unemployment rate back up, I think at that point you'd start to see electorates push back on the political and economic framework that they're inhabiting and effectively seek a different political and economic future in that regard. So I think politics is one fault line that another recession would build up. The other is the financial sector.
Right. The other is financial sector. We'll get there in a moment, but I wanted to ask first about the broader backdrop here. You look at a euro area cyclical indicators, and it has seemed to roll over just a little bit here. This is a case perhaps of Europe playing catching down with weaknesses outside of the eurozone. But with emerging markets having bottomed now, what does that mean for Europe? Does this line keep going down?
I think it means cyclical momentum over the next few months is going to continue to weaken. Europe had outperformed over the last year or so, if you look at the PMIs and other indicators relative to those we'd seen in the rest of the world. And I think this slowdown looks to be pretty broad-based. It's across a whole range of economic indicators. And as a consequence, I think it's likely to continue for at least a few more months. And in that regard, it does put the Eurozone recovery at a bit of a risk, in the sense that, having seen a prolonged period in which economic momentum was strengthening, it is now starting to deteriorate.
Neville, who's to blame for the weak growth in the Eurozone? Is it the ECB not doing enough? It seems like all of Draghi is the only one really doing anything. Or is this something about fiscal matters, heads of state not doing enough to boost things on the fiscal side? What is it that, in your view, is preventing a true robust recovery in the Eurozone?
I think you've hit the nail on the head with fiscal policy. I think if you wanted a silver bullet to sort of really transform the economic outlook in the Eurozone, and in some sense push what's a satisfactory economic recovery into something that looks much more self-sustaining, and one that sort of diminishes those tail risks I referred to earlier, a fiscal stimulus would without question be capable of delivering that upside to growth. In some sense, the weakness in demand is still persistently pervasive across the Eurozone. It's manifest in the continued high levels of unemployment, the high levels of non-performing loans, and of course, not least in the Eurozone's very large current account surplus.
And of course, the other issue, guys, is what happens to banks. I mean,
yes.
If you have tightening credit conditions and weakness in bank equity, we saw it happen with Deutsche Bank and the cocoa bonds. How willing will they be to lend? What will demand wind up looking like? Absolutely.
And Neville, that's a good point. You talked about banks being another major risk here to the economic backdrop. How mindful is the European Central Bank of banks? There has been some commentary about the negative interest rates hurting them, but is it enough to get them to not do something because of the potential damage?
I think it's probably better to ask what they might do in order to help the banks. I mean, for me, that's probably the area I'm most worried about. The Eurozone's been in a pretty virtuous circle over the last few years as financial conditions have eased through the banking system and delivered, in some sense, a stimulus that's sustained what's been a pretty modest recovery. It's absolutely vital that that continues, and I think the stress we've seen in the financial sector in the last couple of months puts that genuinely at risk. I think in part that's a consequence of markets being worried about negative interest rates, and I think as a consequence the ECB will probably shy from being too aggressive in cutting the depot rate. We're only looking for a 10 basis point cut from them on Thursday. Where I think they can help is by delivering credit easing, potentially through purchases of investment-grade corporate credit or a further bold provision of liquidity to the banking sector.
Yeah, I was just going to ask you, what's your full estimate of what you think the ECB will do this week, and how do you think markets will react when that's delivered?
I think markets will react positively, in part because I think expectations are much more cautious going into this meeting. I think it's also the case that the action is much more likely to be bold than it was back in December when, markets were collectively disappointed. If you look at what the economic news has done in the last few months, it's been materially worse than it was in the run-up to the December meeting. Economic data, which were strong, are now weaker, and inflation numbers, which were picking up back in December, at least on the core basis, have started to ease back. So we're looking for them to cut the deposit rate by 10 basis points. We're looking for a larger extent extension of their quantitative easing program, increasing asset purchases by a further 20 billion a month, and also, as I said, some credit easing, most likely through small purchases of corporate investment grade credit.